Most traders lose money because they overcomplicate trading and spend hours staring at the charts every day. But what if you could find high-probability swing trades in less than 30 minutes a day using simple smart money strategies? In this video, you will learn the stop hunt trading strategy, the magnet zone trading strategy, the line of control trading strategy. By the end of this video, you will learn how to spot where institutions trap retail traders, so you take the same trades they take, where smart money accumulate their position before moving up or down, how to draw one line, only one line, to let the market reveal its secrets. The strategies are simple, effective, and profitable. They work on all markets, forex, stocks, commodities, and based only on price action. Before we start, if you like this type of trading videos, make sure to like the video, subscribe to the channel, and hit the notification bell so you never miss future trading strategies. Now let's get started. The first strategy is the stop hunt strategy. The market moves up, reaches a level, and reverses, forming a resistance level. Or the market moves down, reaches a level, and reverses, forming a support level. These levels become important reference points in the market. Many breakout traders place buy orders above resistance levels and sell orders below support levels, expecting the market to continue breaking out. But here is what institutions often do. They push the market above resistance or below support to trigger breakout entries and stop-loss orders, and then quickly reverse the price back inside the level. When the market breaks above resistance and closes back below it, or breaks below support and closes back above it, this is what we call a liquidity sweep, also known as a stop hunt. And that is our first setup. So the strategy is very simple. You open the chart, identify major support and resistance levels, and then wait for the market to create a liquidity sweep before looking for an entry. Now, look at this chart example. This is the Australian dollar versus the US dollar on the daily chart. As you can see, the market previously reacted strongly from this area, creating a clear support level where buyers stepped into the market and pushed price higher. Now look at what happened when price came back to this level again. The market briefly broke below the support level, which trapped many retail traders into selling and also triggered the stop losses of buyers positioned below the support. But instead of continuing lower, price quickly closed back above the level. This is what we call a liquidity sweep. Notice that the sweep was not created by a single candle. It happened over multiple candles, which often makes the setup even more powerful because it shows strong rejection from lower prices and aggressive buying pressure stepping into the market. Now here is the important part. You do not need to stare at the charts all day to find setups like this. This is a daily chart setup. You can simply spend around 30 minutes before the market opens, scan a few charts, identify key support and resistance levels, and look for liquidity sweeps like this one. In this example, the trade entry was taken after the market closed back above the support level. The stop loss was placed below the liquidity sweep lows, and the target was set at the next key resistance level. Look at what happened next. The market moved exactly as expected and reached the target, delivering a clean swing trading opportunity with a very favorable risk-to-reward ratio. This is the euro versus the US dollar on the daily chart. As you can see, the market was clearly trending upward before reaching this area and reacting sharply lower, creating a strong resistance level where sellers previously took control. Now, once this resistance level was identified, the next step was simply to wait and observe how price would react if the market came back to this zone again. Look at what happened next. The market retraced back toward the resistance level, briefly broke above it, and then quickly closed back below the level, forming a clear doji candlestick pattern. This is a classic liquidity sweep. The breakout above resistance trapped breakout buyers and triggered the stop losses of sellers positioned above the level. But instead of continuing higher, the market rejected the breakout and closed back below resistance, signaling that smart money was likely taking control. And because this liquidity sweep happened with a single candle, it created a very tight stop-loss opportunity, which is one of the reasons why these setups can offer extremely high risk-to-reward ratios. Now the trade execution was very simple. The entry was taken after the candle closed back below the resistance level. The stop loss was placed above the liquidity sweep high, and the target was set at the next key support level. Look at what happened next. As expected, the market moved lower and reached the target, creating a clean swing trading setup without needing to monitor the charts all day. Now look at this chart example. This is Nvidia on the daily chart. And as I said earlier, this strategy works across all financial markets, including Forex, stocks, cryptocurrencies, indices, and commodities. Now pay close attention to what happened here. The market moved downward and reacted strongly from this area multiple times. The first reaction created a clear support level. The second reaction confirmed that buyers were still defending the zone. And the third touch made this level even more important because the market kept respecting it. So once we identified this key support level, the next step was simply to wait for price to come back and reveal its intention. Now look at what happened next. The market retraced back toward the support level, briefly broke below it, and then quickly closed back above the level, forming a clear liquidity sweep. This move trapped sellers who entered after the breakout and also triggered the stop losses of buyers positioned below the support level. But instead of continuing lower, the market rejected the breakdown and pushed back upward, signaling strong buying pressure entering the market. Now the execution was very simple. The entry was taken after the market closed back above the support level. The stop loss was placed below the liquidity sweep low, and the target was set at the next key resistance level. Look at what happened next. The market rallied strongly, reached the target, and continued moving higher afterward, showing the power of trading liquidity sweeps on higher timeframes like the daily chart. Now let's move to the second strategy, which is the magnet zone strategy, also known as supply and demand. A supply zone is an area where institutions previously sold aggressively, causing the market to move down with strong momentum. A demand zone is an area where institutions previously bought aggressively, causing the market to move upward with strong momentum. When the market retraces back to a supply or demand zone and gets rejected from it, it creates a potential trading opportunity. The idea is simple. You look to sell from supply zones and buy from demand zones. This is the US dollar versus the Japanese yen on the daily chart. As you can see, the market is clearly trending downward, which means we only want to focus on selling opportunities in the direction of the trend. Now look at these areas on the chart. This is a bearish institutional zone, and this is the next bearish institutional zone. But instead of focusing on both zones, we are going to focus on the most recent one because it is stronger, fresher, and also the closest zone to current price if the market retraces upward. Now pay close attention to the way this zone was created. Look at these large bearish candles. This first candle shows aggressive selling pressure, and the second candle confirms strong bearish momentum continuing into the downside. This type of explosive move is not usually created by random retail traders. It often reflects institutional activity, which is why we call this an institutional footprint. Now also notice something very important. The previous support level was broken with strong momentum, and liquidity was taken below the lows before the market continued downward. This adds extra confirmation that sellers were in control of the market. And before entering any trade, we always want to evaluate the risk-to-reward ratio. Look at this setup. As you can see, the trade offers at least a 3-to-1 reward-to-risk ratio, which means the potential reward is significantly larger than the amount being risked. Now look at what happened next. The market retraced back into the bearish institutional zone, and once price reached the area, an inside bar pattern formed. This pattern signaled a temporary pause in momentum and provided a precise entry setup within the zone. Now here is how the trade was executed. The entry was placed below the low of the mother candle. The stop loss was placed above the zone and above the high of the mother candle. The target was set at the next key support level. This type of entry allows the trade to activate only if the market confirms bearish continuation by breaking below the inside bar pattern. And look at what happened next. The market broke below the inside bar setup, activated the sell position, and then continued moving downward until it reached the target exactly as expected. Now look at another chart example. This is the British pound versus the US dollar on the daily chart. As you can see, the market moved downward, reached this level, and reacted strongly upward, creating a clear support level. Later, the market retraced back to the same area, briefly broke below the support level, and then quickly reversed back upward. This is a clear liquidity sweep. Sellers entered after the breakout below support, and many buyers had their stop losses triggered below the level. But instead of continuing lower, the market rejected the breakdown and pushed aggressively higher. So if you were watching the chart earlier, this liquidity sweep alone could have provided a high probability buying opportunity. Now look at what happened afterward. The bullish move continued higher. Then the market started retracing back again before making another push upward. And this is where things become very interesting. Here we have a clear bullish institutional zone, also known as a demand zone. Look at the candles that created the move. The bullish candles are large and aggressive, showing strong buying momentum. We can also see that the previous resistance level was broken, which confirms that buyers were in control of the market. But the most important detail is this. This is what I call a golden demand zone. If we use the Fibonacci retracement tool and drag it from the beginning of the bullish move to the top of the move, we can see that the demand zone aligns perfectly with the 50% and the 61.8% Fibonacci retracement levels. When multiple factors of confluence align together like this, the probability of the setup becomes much stronger. Now, before taking the trade, we also need to evaluate the risk-to-reward ratio. And as you can see, this setup provides more than a 4-to-1 reward-to-risk ratio, which makes it a very attractive swing trading opportunity. Now look at what happened next. The market retraced back into the demand zone, and once price reached the area, a clear bullish engulfing pattern formed. Now many traders would enter immediately at the close of the engulfing candle, but there is a problem. If we enter at the close of the engulfing bar, we lose the reward-to-risk advantage because the stop loss becomes too large compared to the target, reducing the setup to less than a 2-to-1 reward-to-risk ratio. So, what should we do in this situation? The solution is very simple. Instead of entering at the close of the engulfing candle, we place a limit order at the midpoint of the bullish engulfing pattern. The stop loss is placed below the demand zone, and the target is set at the next key resistance level. This type of entry allows us to reduce the size of the stop loss while keeping the same target, which dramatically improves the reward-to-risk ratio. And look at what happened next. The market retraced back into the limit order, activated the trade, and then rallied strongly upward until it reached the target exactly as expected. Now look at another chart example. This is the Canadian dollar versus the Swiss franc on the daily chart. As you can see, the market is clearly trending downward, which means we want to focus only on high-probability selling opportunities in the direction of the trend. Now here we have a clear bearish institutional zone, also known as a supply zone. So let's evaluate the quality of this setup. First, the zone is fresh, meaning price has not returned to it since the strong bearish move was created. Second, the candles that formed the move are large and aggressive, showing strong selling momentum. And third, the previous support level was broken with momentum, confirming that sellers were in control of the market. All of these factors increase the probability of the supply zone working. Now, before taking any trade, we also need to evaluate the reward-to-risk ratio. And as you can see, this setup provides at least a 2-to-1 reward-to-risk ratio, which already makes it a valid swing trading opportunity. Now let's look at what happened next. The market retraced back toward the supply zone, and once price reached the area, it reacted aggressively and formed a clear doji candlestick pattern. This strong rejection tells us that selling pressure was already present inside the zone and that institutional limit orders were likely waiting there. Now, here is an important lesson. If we place the entry directly at the close of the doji candle, with the stop loss above the zone and the target at the next support level, the reward-to-risk ratio becomes poor and drops below 2-to-1. So what should we do in this situation? The solution is simple. Instead of entering at the close of the doji candle, we place a limit order at the midpoint of the doji candle. The stop loss is placed above the supply zone, and the target remains at the next key support level. This technique allows us to enter the trade at a better price, reduce the stop loss size, and dramatically improve the reward-to-risk ratio. And now, instead of less than 2-to-1, the setup provides approximately a 3-to-1 reward-to-risk ratio. Now look at what happened next. The market retraced back into the limit order, activated the sell position, and then dropped toward the target exactly as expected. The third strategy consists of drawing only one line. When the market is trending upward, you connect the swing lows. You need at least 2 swing lows to validate the trend line, and then you look for an entry on the third touch, as you can see here. When the market is trending downward, you connect the swing highs. Again, you only need 2 touches to validate the trend line, and then you look for an entry on the third. This is the US dollar versus the Swiss franc on the daily chart. As you can see, the market is clearly trending downward, which means we want to focus only on selling opportunities in the direction of the trend. Now let's draw a trend line to see if we have a valid setup. To draw a proper bearish trend line, we connect the swing highs of the market. As you can see, this is the first touch point, and this is the second touch point that validates the trend line. Now technically, if we had been watching the chart earlier, we could have entered on the third touch of the trend line, which often provides a strong trading opportunity. But that's perfectly fine. In trading, missing one opportunity does not matter. The market always provides new setups for patient traders. So instead of chasing the move, we simply wait for the market to retrace again and see if another high probability setup appears. Now look at what happened next. The market retraced back toward the trend line once again, rejected the level, and then formed a clear bearish engulfing pattern. This bearish engulfing candle signaled that sellers were stepping back into the market and that the retracement was likely coming to an end. Now the execution of the trade was very simple. The entry was placed at the close of the bearish engulfing pattern. The stop loss was placed above the trend line and above the engulfing candle high, and the target was set at the next key support level. Look at what happened next. The market moved aggressively to the downside, reached the target exactly as expected, and delivered at least a 2-to-1 reward-to-risk ratio. Now look at another chart example. This is the Canadian dollar versus the Japanese yen on the daily chart. As you can see, the market is clearly trending upward, which means we want to focus only on buying opportunities in the direction of the trend. Now let's connect the swing lows to see if we can draw a valid bullish trend line. This is the first touch point, and this is the second touch point that validates the trend line. Now look at what happened next. The market retraced back toward the trend line, touched the level twice, and got rejected both times. This rejection was our entry confirmation signal because it showed that buyers were still defending the trend line and stepping back into the market. Now the execution was very simple. The entry was placed after the close of the second rejection candle. The stop loss was placed below the lows of the rejection area to avoid getting stopped out by normal market fluctuations and liquidity spikes, and the target was set at the next key resistance level. Look at what happened next. The market rallied upward and reached the target exactly as expected. But now pay close attention to what happened afterward. The market retraced back to the trend line again, briefly broke below it, and then quickly closed back above the level while forming a clear bullish engulfing pattern. This was not only a bullish engulfing setup, but also a liquidity sweep. The breakdown below the trend line trapped sellers into entering short positions and triggered stop losses from buyers below the trend line. But instead of continuing lower, the market aggressively reversed upward, signaling that buyers were still in control. This created another high-quality buying opportunity. The entry was placed at the close of the bullish engulfing pattern. The stop loss was placed below the liquidity sweep low, and the target was set at the next key resistance level. Now look at what happened next. The market continued moving upward, reached the target successfully, and delivered approximately a 2-to-1 reward-to-risk ratio. Now let me show you how one line, only one line, can help you predict trend reversals before most traders even realize what is happening. Look at this chart example. This is the Australian dollar versus the US dollar on the daily chart. As you can see, we have a clear bullish trend line. This is the first touch, this is the second touch, and this is the third touch. Now look at what happened next. The market broke below the trend line. This breakout signaled a potential trend reversal because buyers were no longer able to maintain the uptrend. After the breakout, the market pulled back to retest the broken trend line and then formed a clear doji candlestick pattern. This was our trade setup. The entry was placed at the close of the doji candle. The stop loss was placed above the trend line and above the doji high. and the target was set at the next key support level. Now look at what happened next. The market moved downward and reached the target exactly as expected. Now, I hope you enjoyed these strategies. If you found this video helpful, make sure to like the video, subscribe to the channel, and hit the notification bell for more smart money trading content. Thank you for watching and see you in the next video.